All right, excellent. Hey guys, welcome. Good evening. My name is Jesse Reynolds. I'm so excited that you are joining us here on the Hidden Retirement Threats Zoom. This is going to be high value. We're going to go ahead and we're going to dive right into it because we got a lot to cover. And
Morning.
you guys are taking some notes here. And so we're going to start with just a simple question, but kind of a funny story from a movie that probably, if you're thinking about retirement at this point, you're probably old enough to remember this movie. But Titanic was it like 26 years ago when it came out? Obviously, it's about the real life story about the Titanic, and I'm not gonna go through all the stuff in the movie, except that it was such a great example for me of what is going on for so many people when it comes to retirement. The reality is the Titanic was obviously a very tragic story where there were several points along the path where they could have prevented that from happening, right? They could have prevented that from happening, but they did not, simply because they ignored the signs, right? They said it was the unsinkable ship. They had hubris. They were, there was things that were going on down in the engine room, and they were heading towards that iceberg. And the whole time you're watching that movie, like, because it's a historical event, we all know how it ends, right? The boat sinks, almost everybody dies, and it's super sad, super tragic. That is what's happening for so many people when it comes to a lot of the plans they have in place. There are retirement threats below the surface that they're heading towards them. They might not be hitting them today, and so they might just be partying and dancing on the deck of the Titanic, but it is looming in the distance. And unless there is a change of course, we know what's going to be is ultimately going to be that crash collision, right? And so if you knew back in the early 1900s what was going to happen, you never even got on the boat, right? And so what we hope to do is to show you where the icebergs are, help you understand the course of the ships that you guys might be on cruising across the Atlantic right now, and help you either get off the ship and or change the course of the ship that you're in if you see and understand that these are affecting your current retirement accounts. Okay. So what are the hidden retirement threats? The first one is simply average rates of return. And what's really important to understand on this tonight is what we're going to be discussing. While I certainly have opinions, I'm really going to try to keep my opinions out of this. And we are just going to be looking at math and historical returns. And so there are obviously other market indexes out there, but the S&P 500 is kind of, it's kind of the big boy. And so we're going to be referencing that throughout this tonight for consistency, and because one of the challenges, I've shared this presentation now with hundreds of clients across the country. I don't even know the count. I've lost count. Hundreds and hundreds, probably close to 1,000 people at this point. One is I've never met with somebody who knew all three of these threats already, and most often the feedback is something along the lines of, wow, I learned more in that 30 minutes meeting with you than I did in 20 years talking to my money guy. Because too many times people are just being sold products and they're not being educated on how things work. And the reality is no one is ever going to care more about your retirement than you are, right? So that's super important to understand. And so while there may be some very significant solutions that myself or one of the financial professionals on my team might be able to help you with, ultimately, you have to understand what they are, and you have to be the one who determines if they properly fit your financial goals for your family, for your retirement. And so we're just going to look under the hood. Okay. So let's first start by talking about what's called average rates of return. This is the first threat. And the reality is there's so much financial trickery out there. We can do like really micro view looks at things and take a small snapshot of time in a certain index in a certain company and all, and we can kind of come up with whatever numbers we want to. But when we take a very macro view, a very wide view, so like what we'll be looking at here is since the start of the century, back in the year 2000, it gives a much better picture of what's really going on. And so what you see here on the screen is these are the historical returns of the S&P 500 since the year 2000. Okay, so that's 25 years, right? 2001, 2, 3, all the way through 2024. We're in the end of 2025 as I'm recording this. And listen, the market's done very well. Nothing I'm going to say is going to be bashing the market. That is not my aim or objective with this at all. the market has done very well for a lot of people. However, because of these threats, there's unfortunately a large part of the population where the market, it's not if it does well or not, is that it doesn't do what they were led to believe it was going to do. And that's where the problems can start to happen. So what has been the historical return in the S&P 500 since the start of the century? It's been 7.32%. You can see right at the bottom of the screen there. And so what this shows you is, if you had put $100,000 into the S&P at the start of the century and just let it ride, you would have made money. Your money would have grown from about 100,000 to 400,000. And that's definitely significant growth over that period of time. And that's fantastic. And like we said, it's the average return of 7.32%, but this is where the first threat comes into play. Again, it's not that I make money or not, but where the first of the three hidden retirement threats comes into play is that average rates of return are not the same thing as actual rates of return if there's ever losses. Okay. And then we look there, 2000 was a loss, 2001 was a loss, 2002 was a loss. And then look, 1, 2, 3, 4, 5, gaining years. 2008 was a loss. The vast majority of the years in the market are gaining years. It's usually 1 out of every 3 or 4 years is a losing year. And then the other 2 or 3 they're gaining years. And that's fantastic. Again, case proven here, 100,000 in the market, 25 years later, it became 400,000. All right. So that's real, but there are losing years. And so you need to understand when you're being shown average rates of return, they're not the same thing as actual rates of return. So I'm going to prove it to you. So we're all going to take a math test together here. And let's assume that you started with $100. Okay. And if over the next year, if you lost 50% of that money, how much money would you have? Everybody usually gets the first answer right. So you'd have $50. Now, this isn't supposed to be a trick question, and so it's okay. The vast majority of people get the second question wrong. Now, what if in that second year, if that $50 grew by 50%, how much would you have here too? Most people say most people say $100 because they think lost 50, went up 50, but the actual answer is $75. And so let me know in the chat if you got $75. I know some of you guys have already seen this before. Some of you guys are probably math whizzes. Well, why is that? It's because losses are weighted more heavily than gains. See, when you had a 50% loss in the first year, you actually needed a 100% gain in the second year in order to get back to where you were before that. Okay. And so what happened here is you went down 50% the first year, up 50% the second year. So that was an average rate of return of 0%, but an actual loss of 25%. So now the market doesn't do 50% swings from one year to the next. I'm not trying to suggest that's what happens. I'm giving a slight exaggeration here to help you catch the math and catch the principle that's happening every time there's a 10% loss here and a 23% loss here and a 15% loss there. Like those are adding up and they are shifting what the actual returns in the market wind up being. So let's look into a little further with it, where again, we talked about how that was the actual return was actually a $25 loss. Let's now look at the difference of how much did a few losing years cost you relative to an actual return of 7.32%. So on the left side, those were the historical returns in the S&P this century, which again was an average return of 7.32%. Over here on the right-hand column, you'll see it's just an actual 7.32% every year. So it's the power of 0. Now, you can't just wave a magic wand and remove market losses inside of market-based products. We'll talk more about some solutions at the end of this. But so just know that if you did have an actual 7.32% where there never were losses, and you put that same 100,000 in the market and you just let it sit for 25 years, you'll see that instead of 400,000 like you have on the left-hand side, you'd have had 584,000 on the right-hand side. That is $184,000 rounding error. I think a lot of us would agree that's a pretty significant rounding error for most folks. Both the left-hand side and the right-hand side have average returns of 7.32%, but because pretty much everybody has their money where there's exposure to market losses, if you had this scenario and you were planning on an average return of 7.32% and expecting it to be an actual return of 7.32%, again, you would have come up $184,000 shy of where you expected to be. Now, again, I'm not suggesting that your money didn't grow in the market. Again, it grew in the market during that time frame. But the challenge, why this is such a significant threat is, when you're 35 years old and you're sitting down with your money guy and he's saying, okay, you put this much with me and you're going to get this average return for this many years. And then you're going to be this age and you're going to have this much money. And then you're going to be able to retire and sip out of a coconut, right? That's kind of how that process goes. But if you're using numbers that don't actually exist, your statements will keep saying average returns, average returns, average returns. But then you look over time and it didn't actually turn out that way. The problem is, back to the Titanic example, the best way to avoid hitting that iceberg is never getting on the boat. Or as soon as you got on the boat and you realized what was going on, changing course. Okay. So the sooner you realize and understand this, the more significantly you're able to avoid those potential pitfalls. Okay. But now here's another thing that happens is obviously losses are not fun, but there's just some other things that are commonly said in the financial services world by most folks. I am generalizing. And so please, again, like if you're your best friend or your uncle, if they're a financial planner, I don't mean anything disrespectful towards them. Just in general, and this is not only true for the financial services space. We find this in the medical field and many other areas where, when all you have is a hammer, everything looks like a nail. There's certain things that they're trained to do, and they might be really good at the things that they're trained to do, but they don't always consider the things outside of what they're trained to do. And so just, again, we know and understand there's going to be losing years in the market, and that's just part of it. Again, I'm in no way indicating or suggesting the market's a bad place to be, but I am trying to help shine a light on some issues and some shortfalls, because there's no such thing as a perfect financial investment. Every financial investment out there has strengths and weaknesses. And that goes back to the education. It is, I believe, is grossly irresponsible to just say, this is the thing you must do, when I don't understand who you are, what you value, what your ultimate goals are, what your family dynamics are, what your financial background and education, like those are all important factors. And the real key in any of this is the more you grow your financial IQ, the better able you are to be able to determine what is the wisest course forward for your family, right? So one of the things that is just said all the time is, hey, just sit, just ride it out. The market always bounces back. And you know what? That's absolutely true. The market always bounces back. But what's not always acknowledged in that is how long might it take to bounce back. So you'll see here, again, looking on the left-hand side of that red box we got there, you put 100,000 in the market in 2000. Well, 2000, the 2000s were rough, right? But 2000, 2001, 2002, 2008, those are some rough years. And look, there were some fantastic years, 2003, 2006, 2009, 2010. Those are great years in the market, 2012, 2013. Well, the thing is, did the market bounce back? Yes. But if you had 100,000 that you put in the market in the year 2000, you just had the wrong timing of it. How long did it take for your money to bounce back? It took 13 years. You see that, where it wasn't until after 2012 where your money got back up over $100,000 again. Now, here's the reality is, when you're younger, you absolutely can afford to ride those out. Now, you may not want to ride that out. I understand that, but you can. If you're in your 30s and yet 13 years from now, you're probably, for most folks, not retiring by 43. And so you do have that luxury of time. But what about the guy that was 65 and had worked for 35, 40 years and was just about to retire in 2000, and then 2000 happened? And now, where he went, one day he had enough money to retire, and the next day he didn't for 13 more years. Right? Would you agree that that's a pretty significant difference, or a pretty significant delay if you time it wrong like that? And so again, it's important just to understand the impact that losses can have. Again, not saying don't put your money in the market, but I am suggesting that it's important to understand some of these things that are often overlooked, that are relevant for most everybody's retirement accounts there. Okay. So first threat was average rates of return. Second threat, we are now going to talk about management fees. Now, management fees A basic adage you're going to hear again is like, hey, it's only, it's only 1% or 2% or 3% or whatever it might wind up being. But what is the cost that we actually come up with those fees? So you have to first understanding it back to when all you have is a hammer, everything looks like a nail. Again, I'm not suggesting that money guys are bad guys. I think many of them are very well intended. And I think many of them have helped their clients in a lot of great ways. I'm not trying to suggest that, but you have to understand how financial incentives work. And by and large, their world operates around what's called money under management, right? And so of course they want to grow your money, but they also want you to put as much money with them as you can and keep it with them as long as you can, because they're making those fees, oftentimes between 1 to 2.5%. And again, some people have lower fees, some people have higher fees. We're just going to kind of split the difference on that in just a moment. We'll look at a 1.7% fee. But one of the first things to consider, though, is what are they actually managing? What are they actually doing to earn that 1, 2, or 3% per year fee? Okay. And is there accountability for results, right? I have no problem paying somebody who's making me money. That's a fantastic thing. I love that. I've used several trading services and different things that have been very profitable for me throughout the years. But I do have an issue with paying somebody to make money when they actually lose me money, and there's no accountability for results where they still get paid, right? Is it possible, like in those years when there's those bad market downturns and they're saying, hey, just ride it out, like stay with me, market's going to bounce back, which again, as we know is true. Okay. Is it possible that if they didn't get paid in the years where there's those downturns and those losses and those ride it out days, that maybe they would offer different advice? But the reality is, for most of them, they still get paid the same either way, whether you actually make money or not, because there's a lack of accountability for results. And so it just doesn't, for me, it's never really aligned right from a priority standpoint. And like I said, they're usually going to tell you it's only a small fee. But again, what are you actually paying for with that fee? Do you truly understand what it is that you're getting in return for that? And how much does that small fee actually cost? So we're going to look at now, what does a 1.7% fee, right? They're oftentimes between 1 and 2.5%. We're just going to split the difference and just look at a 1.7% fee. So on the left-hand side, again, it's that same S&P 500 25-year return that we've been referring to the whole time, which has averaged 7.32%. Now, on the right-hand column, all we're going to look at is the exact same returns in the market with a 1.7% fee taken out of it. That is the only difference that we're going to do now, okay? So when we get down to the bottom right here, instead of having $400,000 after 25 years, that only 1.7% fee, we now have only $264,000. So how much did that only 1.7% fee cost? It cost $136,000. Would you agree that's a pretty significant rounding error? Not an error, right? Rounding omission, right? Where people just aren't accounting for this. Again, I'm not saying that your money didn't grow. Again, you started in the year 2000 and you had 100,000, and now 2024 you have 264,000. Your money grew during that time frame, but I would strongly suggest that for most people, that's a lot less money than they expected to have 25 years later. And that's, again, the point that we're trying to talk about here. And again, we're at all different points in their stages. Some of us might already be retired on here. Some of us might be closely approaching it. And some of us might be very early on in our working careers, right? So like we're at different points on that Titanic journey. But we need to simply assess the information we have to try and make the wisest decisions for ourselves to be great financial stewards moving forward. But so now let's compare. This is where we're going to really get into some math of it. So remember now that 100,000 in the market with a 7.32% average return and a 1.7% fee, we now move this over to the left side, right? So you see that 264,000 down on the bottom left. But now we're going to say, what did it actually take to beat the market during that same period of time if we simply had no exposure to losses and we were not charged management fees? So you'll see here on the right-hand column, if you had that same 100,000, and then for 25 years, if it only got a 4% return with no losses and no fees, your money grew from 260, instead of 264,000, your money actually grew to 266,000. So slow and steady won the race. Now, I'm not suggesting that you should only be going after 4% gains. That's not what I would advocate for necessarily. But I do think this is pretty telling. How many people who entered the market in 2000 and planned on retiring 25 years later were operating with that number of, hey, I'm only going to see a true net, right, of after losses and fees, a true net of only 4% per year average like that. I think most people would have made adjustments in the retirement plan 25 years earlier if they actually understood what was going on with those rates like that, right? Again, we see that 264 on the left, that 266 on the right. It only took 4% to beat the market when you factor in exposure to losses and management fees across that same time frame. Okay. The third retirement threat, again, the first one was average rates of return. The second one was management fees. This third one now is sequence of returns threat. And honestly, the older you are, the closer you are to retirement, and or if you've recently entered retirement, this is the most relevant of the three of these. Okay. So I'm gonna reference something that is commonly used in the financial services world, and we're going to circle back to this in just a few minutes, a little bit later. But because financial professionals understand the previous threats that we just discussed, especially the average rates of return, there's something in the financial planning world called the 4% rule. And basically, it's because they understand that there can be losing years. People, I think, generally accept that losses are not a good thing. I don't think there's anybody out there trying to like paint it up like, hey, check out, losses are awesome. Nobody's saying that. But there's a certain type of loss that you absolutely can't afford, right? So people know losses are never good. But the one loss that is way worse than any of the others that can prevent you from being able to recover from in terms of retirement is losses in the early years of retirement. When you have losses in the early years of retirement and you're taking distributions, right, withdrawals from that account, the losses can compound on top of the withdrawals, the distributions, at a rate so fast that your account cannot recover from it. Okay. So because of that, the financial planning world, they commonly use what's called the 4% rule. Again, your financial professional might use something different, but you can Google it. This is a pretty commonly accepted rule. And so they would say, because we know that losses can happen and will happen at certain times. And because if you time it wrong, the absolute, just if it's just that wrong set of circumstances, like the early 2000s were, you could have all of your retirement funds completely wiped out if you withdrew too much income from it. So they would say, if you have $1 million, so let's go back to the year 2000, and let's say instead of having 100,000, let's say you had $1 million in your retirement account. So if you were following the 4% rule, well, then they would say don't withdraw more than 40,000 per year, because we know the market average is 7.32% that time. In fact, what we're going to look at now, we're just assuming no management fees. I'm not even like, we're just going to be generous and say there weren't any management fees now. That would be to make sure that you don't run out of money, that 40,000 per year. Usually a lot of people, when they first discover this 4% rule, they think, wow, that sounds kind of low. Like, you mean I have over $1 million and I can only live on 40,000 a year? Most people can't live on 40,000 a year now. Like, how am I supposed to live on 40,000 a year in retirement, right? And so this example shows you here on the left-hand side, what if you just slightly exceeded the 4% rule, and in the year 2000, you had that $1 million, and you said, hey, I'm going to withdraw 5% of my money, which is $50,000 per year. So that's what we see here is we see the $1 million starting off, the same market returns and losses, which again, 2000, 2001, 2002 were losing years, and that same $50,000 withdrawal, you'll see how by the year 2017, you ran out of money in 17 years. Doesn't that sound wild? That you had $1 million in your retirement account, the market averaged 7.32%. We're not even charging you management fees. You're only withdrawing 50,000 a year on it, and you run out of money in 17 years. That's not, I mean, if you just put $1 million in the bank, you would have gotten at least 20, and earned 1% interest or something. You would have gotten over 20 years out of it. Isn't that wild? Just the wrong set of circumstances. Now, thank God we don't see early 2000s situations all the time like that. That's a good thing that doesn't happen regularly. But again, if you were one of those early retirees and you had just entered into retirement, that completely devastated just millions of Americans. And the real challenge is, when's that going to happen again? Nope, none of us know, right? I mean, if any of us truly knew how to trade and time the market like that, probably none of us would be on the Zoom here tonight, whether you're watching this live or on the replay. Most people don't know. And the question then becomes is, if you understand that this is a possibility, but you don't know when it's going to be, are you okay leaving that exposure to that threat to your retirement account? Because what if you worked hard for 30 or 40 years and you go to retire and then bam, there's another dip like that. And you're like, shoot, I can't afford to retire because I don't want to run out of money. Right? Like, are you okay leaving it up to chance like that? Because what is the market going to do when you retire? Nobody knows. So what I want to show you now, while we can't do this, I just want to really emphasize it. So what is the sequence of returns threat? Is simply the order in which your returns happen matter. And again, specifically, having exposure to losses in your early years matters. So on the left-hand side, we have that same example we just looked at. You had $1 million in 2000, and you withdrew 50,000 a year, which is 5%, and your average return was 7.32%. On the right-hand column, we have the same $1 million. We have the same $50,000 per year withdrawal, but all I did was I just switched the order. I ran it in reverse. Okay. Now we can't actually do this. That's not the point. But just to show the point of when we experience losses in retirement matters, you'll see that, that 2024, 2023, those first 2 years, they were not losing years. Just by changing it where, again, 2022 was a big losing year still, but just by not having consecutive losing years early on, even though we have that same $1 million and that same $50,000 per year withdrawal and that same market average, right? These are the exact same returns, 7.32% on the left, 7.32% on the right. 25 years later, you still had $1.7 million in your retirement account. That is a significant difference, right? The left-hand side and the right-hand side. The only difference was not having losses in those couple of early years like that. And so what's great is you can do something about that if you want to. I hope that we grab this concept that you cannot afford losses in your early years of retirement. Okay. So what can you do? So I'm not going to really get into this first one. There's this great play called private family banking, infinite banking, cash flow banking. You use certain contractual provisions inside of certain insurance products that you can have tax-free growth. You can have equity control. You can have legacy wealth transfers. There's some great things that you can do with it. I'm not really going to get into that much at all. But again, if you want to learn about that, just know that is something that my family, we have done very successfully. We love that play. We've helped hundreds of families around the country implement for themselves. And it is not some sort of latest, greatest thing. You just reach out to myself or whoever invited you to watch this video, and they would be happy to talk with you more about it. So the other thing that you can do is that you can have what anecdotally or descriptively, not anecdotally, descriptively we refer to as zero floor, zero fee retirement accounts. That's not their technical name. It's just descriptive of how they work. They're called fixed indexed annuities. But some of the benefits of them is you can have them structured where your money can be indexed against the market. It's not actually in it, but it's indexed against it. And so you have a 0% floor where your money can only go up from year to year and never have those down years, right? So that can be really powerful. We just a minute ago, we looked at, think about that retirement situation, having a couple down years early on in retirement completely devastated that retirement account, in that 2000 through 2024 example, right? They've been around for a super long time, tons of upside and growth, proven history. And it's a way that you can lock in your gains. And many times you can completely eliminate management fees as well, which can be powerful. Remember the effect of that 1.7% management fee, that can be super powerful there. I'm going to just touch on two features that can be significant with index annuities and why some people enjoy these. And it simply has to do with what not everybody realizes is the insurance-based retirement system has been around way longer than what you and I know as today's traditional retirement system. Today's traditional retirement system, I'll show a screenshot in a minute, but It started back in the 70s. It was the Employee Retirement Income Securities Act of 74 is when all that started. But so insurance carriers, their actuaries, they are some of the most consistently profitable companies on the planet. And essentially what you do is you're partnering with them where they're leveraging your capital and you're leveraging their consistent profitability and investment expertise. I mean, some of these insurance carriers have been turning a profit every single year, not most years, every single year since the 1800s, the Civil War, some of them. I mean, it's insane. And when you can have that type of financial expertise that you partner with, again, it's an alignment of priorities too and incentives. They don't do it for free. They're in it to make money, but instead of just skimming, their 2 or 3% a year off the top, whether your money goes up or down, they are financially incentivized to help grow your money. And the more they grow your money, the more that they can grow their money with it as well. So they leverage your capital, you leverage their investment expertise. And because they are actuaries and they use the law of large numbers, they are able to offer guarantees, contractual guarantees that could align with some of your financial priorities. These are just for illustrative purposes. These are real numbers to real clients I've recently helped, but please, I'm not promising you anything with what you could or could not do. These are things that I would encourage you to explore. But so one powerful advantage that a lot of people like is many times you can actually get contractual bonuses for rolling over old 401ks, IRAs, 403bs, TSP plans, Roths, any of those. Any type of qualified or non-qualified retirement plan can be rolled into one of these products, and they maintain all their tax status designation. There's no taxable event. There's no early withdrawal penalties, none of those things. But one thing that they'll sometimes offer is they'll offer immediate upfront bonuses for doing that. So at the time of this recording, literally a week ago, I just helped a client. She rolled $870,000 from her old 401k. And on that particular product, she got an immediate day one 14% bonus added to her account. So her balance grew up to almost $992,000 the very first day. And again, all the zero floor features and all those things that we talked about previously, they're all in there as well. But that might be a situation for someone where maybe you've recently experienced some losses in the market and you're wanting to recover them quickly. That's kind of why they put those there. Again, there are tons of carriers, tons of products. You need to meet with somebody who knows what they're doing, who's experienced, to see if that could be a good fit for you. Okay? I'm not saying that you're going to get this or you should get this, but I just want you to be aware because most people are not. It's an option. The second area where these can really be powerful have to do with that third hidden retirement threat, which was sequence of returns threat. So remember how we talked about that 4% rule, and honestly, it's there for your protection. It is very wise and a good thing if you have that exposure to losses in your retirement account, like most people do with market-based products. You do not want to run out of money too early. That's the number one concern of retirees. But so again, so just some simple math. If you had this was another client of mine here recently, where she had approximately $800,000 in her retirement account. And, she was in her late 60s and she was wanting to retire, and she's just kind of crunching the numbers, right? She knew about the 4% rule, and, she was looking at, man, 32,000 wasn't enough for her and her husband to be able to afford to retire. Well, we were able to shop around and find the right, as a broker, I contract with hundreds of carriers out there. I was able to find her the right product that met their needs and everything. And long story short, it had an immediate 7.41% guaranteed income distribution and what's called a joint spousal. So it was not only for her, but essentially what they did is they said they guaranteed that for the rest of her life and his life, even though it was her 401k, for her life and his life, they were going to pay a guaranteed 7.41% of the balance for the rest of both their lives, which was $59,280 annually instead of $32,000. That was an extra $27,000 a year they were making immediately there, but from an income perspective, right? Because everybody thinks they care about their 401k balance. I'm not saying you don't want to grow your retirement balance. You do, but what you really care about is how much of that can I spend? How much of that can I live on? And so like in their scenario, they were able to use the income guarantees because these insurance carriers are not investing in super risky, super highly speculative investments, because they are able to control the risk factors and the exposure to losses. They're then able to offer, in many times, not all the time, many times, these higher income distribution guarantees. And, and especially like talking to husbands, this is like old school pensions. You're essentially creating a private pension for your family where, I know talking with many men who are approaching retirement or in retirement, besides just not running out of money, really their other top concern, maybe their even higher concern, is making sure that their wife doesn't run out of money when they pass. Right. And so, you might be in your late 60s and like getting a big life insurance policy. Maybe that's not in the cards and doesn't make sense. But being able to put a joint spousal rider on your retirement account to make sure that your wife's going to have that guaranteed income month after month, year after year, even if she lives 25 years longer than you, like that's a really powerful option. And so these are just two different features. There's so many other things that you can do with these products, but you want to work with an income distribution specialist. So I want you to know those are out there. If you have questions about them, write them down. But if either of those features I mentioned, if you're having some type of thought like, well, it almost sounds too good to be true, how come I don't know about this? Reminded of that Mark Twain quote, it ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. And so just unfortunately, what most people don't realize, like I mentioned about the Employee Retirement Income Securities Act, what most of us on here probably, we don't remember any type of income or any type of retirement service outside of the 401k and IRA, because that's what everybody we know is doing. But they are a recent phenomenon. They just started 50 years ago. Prior to that, the vast majority of people had pensions. And I just talked about the power of what can happen with income guarantees. Okay. And again, that's between you and the insurance carrier and the financial professional you might work with who might help you with those things. But you have to understand that there was a big shift that happened back in the 70s with retirement planning. And there's four main players who don't want you to know about those two plays again, the private family banking or infinite banking, as well as these fixed index annuities. The government, on the infinite banking side, they want their tax day, right? And they're not big, even though it's totally legal. Again, there's videos, there's resources we can get you. Meet with one of us. We'd be happy to explain it to you. But the government doesn't love the idea of your money growing tax free, so they don't want people knowing about these options. Wall Street, they want everybody coming into Wall Street and put as much money as there as they can and keeping it there as long as they can. They directly benefit. You look at the stock market since the early 70s. Essentially, what started happening with these 401ks is you took the largest population in American history, the baby boomers. They're all starting to enter the workforce, and you start siphoning a part of their paycheck directly to Wall Street, out of sight, out of mind, before they ever see it or touch it. And that's created this great big boom. And so Wall Street doesn't want to disrupt that. Money guys, we talked about management fees. I'm not in any way suggesting that they're bad people at all. Okay. I think they're very well intended, and I think they bring value. But like we said, when all you have is a hammer, everything looks like a nail. There's other ways to there can be other ways to more effectively and efficiently accomplish your retirement goals without taking on unnecessary risks. But they don't make their 2 or 3% a year if you go pursue those. That unfortunately doesn't align always priority wise. And then financial entertainers. So I'm not going to pick on any of them specifically, but you could think of some money guys you hear on the radio or you watch their podcast and all that. The reality is, but again, I think they're great people. I think they've helped a lot of folks, but they have their one way of going about it. They kind of got their shtick and they yell at you for, what are you stupid? What are you nuts? Why are you doing this? And they have their thing. And then on their websites, they have these, Reddit, these credited SmartVestors that you can go and they're spending $10,000 and $20,000 a year to advertise. And I don't fault them at all. They have built their platforms and they are making, they're monetizing it. That's a fantastic thing. But you have to understand just simply, why do the majority of people not pursue these other options? It's because too many people are making too much money not telling you about them. Back to what I said at the beginning of this, the importance of financial education. So what's next here? The first one is simply take action. If something that I discussed on here is of interest to you that you didn't know about, you want to learn more about, explore it. Okay. Get back with whoever invited you to check out this video. Most likely they are either one of the financial professionals on my team or they are satisfied clients who just really love the solutions we help them with. That is I literally spend $0. Or again, we've got clients in 40 states. We've been very blessed with how we've been able to help people better protect and grow their retirements. But we spend $0 on ads. We don't buy leads. We don't do any of that stuff. We treat people with first-class service, and thankfully, many of them are so satisfied and pleased with what they have. They, on their own, choose to share those. So you probably either got invited to see this video by one of my team members or one of our clients. So please get back with them and ask them how you can set a meeting, and just schedule that free wealth strategy session. Don't leave questions unanswered. Don't miss out on what potentially could be the missing piece between the retirement that you have to settle for and the retirement that you truly want. And so God bless you. Thank you so much for checking this out. We look forward to helping you achieve all of your financial goals.